Let's jump right in. Welcome to today's Explainer. We've got a really fascinating financial mystery on our hands today, and it surrounds one of America's absolute strongest auto parts businesses, AutoZone. On the surface, investing seems like a piece of cake, right? Find a great company, buy the stock, watch it go up. But as we all know, the market is rarely that straightforward. So we're going to put on our detective hats and dig into a case study that perfectly illustrates the crucial difference between a high-quality business and a high-priced stock. Okay. $2,955.35. That is the price tag for just one single share of AutoZone from our recent market snapshot. But here's where it gets interesting. On the day we grabbed this snapshot, the stock was actually down a little over $43, which is roughly a 1.5% drop. Now sure, stocks bounce around every single day, right? But this specific drop is what really kicked off our investigation. Because AutoZone, it is definitely not behaving like a company whose business is falling apart. Actually, quite the opposite. And that brings us straight to the central mystery we're tackling today. Why on earth are investors selling off one of America's strongest businesses when its underlying earnings engine is absolutely still humming along? I mean, think about it. If a company is successfully selling more stuff and making more profit, shouldn't the stock price naturally go up? Well, the truth is, the price tag alone tells us almost nothing. It's basically just the surface temperature. To figure out what the market is actually reacting to, we really have to pop the hood and look inside. Let's look at the sheer strength of AutoZone's fiscal Q3 2026 results. This business is without a doubt growing. We're talking sales hitting nearly $4.8 billion. That's an 8.4% jump. Operating profit? That climbed 6.6% to almost $924 million. Net income grew by 5.4%, and total company same-store sales ticked up 3.9%. Honestly, these are fantastic numbers for a mature, established retailer. When a massive company like this can still meaningfully grow both its top and bottom line, it's a huge neon sign that their fundamental operations are super healthy. So here's our first big clue. The business is growing, but the stock is falling. What exactly are investors seeing that these headline numbers aren't telling us? To figure that out, we need to understand the company's defensive moat. And this reveals a really powerful, hidden reality about AutoZone's business model. In Q3, a staggering 85% of their sales came from failure and maintenance-related categories, leaving just 15% for discretionary stuff. So what does that mean? It means AutoZone isn't sitting around hoping a customer wakes up and thinks, hey, I kind of feel like buying a shiny new accessory for my car today. No, they rely on that moment of panic when you realize your car won't start because the alternator just died. Look, you can put off buying a new big screen TV, right? You can delay a vacation. But if you need your car to get to work, you literally cannot postpone fixing it. That gives AutoZone this incredibly resilient demand engine, even when everybody is panicking about the broader economy. Recognizing this kind of baked-in resilience is just a fantastic tool for evaluating the strength of any company you might be eyeing. But if we dive a little deeper into the math from those earnings, we stumble onto a really fascinating hidden mechanism. Okay, track with me here. Sales grew at 8.4%. Net income grew at 5.4%. But earnings per share, that grew at 7.7%. Did you catch that? Earnings per share grew significantly faster than the total net income of the entire company. Now, as an investor, whenever you see profit per share climbing faster than the actual total profit of the business, a light bulb should immediately go off in your head. It means there is a very deliberate financial engine working behind the scenes. And that brings us to the crucial point, how AutoZone allocates its capital. You see, unlike a lot of mature, highly profitable companies, AutoZone does not pay a regular quarterly cash dividend. If you're buying this stock waiting for a dividend check in the mail, you are totally missing the point of the investment. Instead, AutoZone has built what is arguably one of the most powerful shareholder return machines in all of retail. And they do it through aggressive share repurchases. It's kind of like, imagine the company's total profits as a giant pizza. Now, instead of handing you a slice of that pizza every quarter as a dividend, AutoZone takes its cash, buys out other people sitting at the table, and takes their plates away. So the pizza itself might only be growing slowly, but because the number of people sharing it keeps shrinking, your slice, it just keeps getting bigger and bigger. And let me tell you, this machine is running hot. Back on June 16, 2026, AutoZone's board authorized another $1.5 billion of common stock repurchases. A cool $1.5 billion. They are literally continuously taking the cash they make from selling car parts and feeding it right back into shrinking that share count. This totally explains why their earnings per share can shoot up 7.7%, even when the total net income only grew 5.4%. It's an absolute masterclass in per share compounding. And frankly, this is exactly the kind of smart capital allocation you want to look for in other mature cash cow businesses. But as we all know, every machine has a breaking point. Which brings us to the real tension of our whole investigation today, valuation. Because when you buy a share of AutoZone right now, you aren't just buying today's stores or today's earnings. You're buying the rights to that future stream of cash flows. At the time of this analysis, AutoZone had a market cap of nearly $50 billion, and it was trading at a trailing price-to-earnings ratio of about 20.3. Now, a 20 times multiple isn't automatically wildly expensive for a truly great business, but it definitely isn't cheap. The market is essentially pricing in the expectation that AutoZone is going to continue executing flawlessly, shrugging off inflation, and compounding those per-share earnings for years and years to come. But the incredibly dangerous question is, what if they don't? And that creates your classic showdown between the bull case and the bear case. The bulls can enthusiastically point out that AutoZone has essential, unshakable demand, positive comparable sales, enormous scale, and that relentless buyback engine that's constantly juicing shareholder value. But on the flip side, the bears, they aren't actually arguing that AutoZone is suddenly going to become a terrible company. The bear case is strictly about expectations, and this concept we call multiple compression. Even AutoZone themselves are quick to point out risks like consumer pressure, inflation, rising wage costs, and supply chain headaches. If their earnings growth slows down, even just a tiny bit, pragmatic investors might suddenly decide, you know what, I only want to pay 16 to 18 times earnings for this, rather than 20. And if that multiple compresses, the stock price can drop like a rock, even if the underlying business is still perfectly profitable. That right there is the absolute critical difference between business risk and valuation risk. So where exactly does this leave us as investors today? Well, the story is actually still incomplete. We know all about the massive retail network they've built over the last decade. We saw the strong spring 2026 earnings. We know about that massive $1.5 billion June buyback, and we see the current stock price hovering near $3,000. But here's the thing. Their fiscal year actually wrapped up on August 29th, and the all-important 14-week fourth quarter results are set to drop before the market opens on September 22nd, 2026. This upcoming earnings report, it is not just another headline. It is literally the final puzzle piece for their entire fiscal year. So to solve this mystery once and for all, when September 22nd rolls around, we need a very specific scorecard. There are 4 vital metrics we absolutely have to watch to see if this premium valuation actually holds up. First up, comparable store sales. This is going to tell us if that core retail engine is still generating raw demand. Second, operating margin. Is all that revenue growth actually efficiently turning into profit, or are things like rising wages and inflation just eating it all up? Third is free cash flow per share. Honestly, this might be the single most important metric for AutoZone because it proves whether their accounting earnings are turning into actual spendable cash. And finally, number 4, the ending share count. We need proof that those billions in buybacks are actually increasing your percentage claim on the business. If those 4 gears are all still turning, the compounding machine is alive and well. And that brings us to our final verdict for today's explainer. Right now, AutoZone is a solid watch. The evidence overwhelmingly proves that this is a high-quality, incredibly resilient business. No doubt about it. But investors are already paying a pretty steep premium for that continued execution. And honestly, it perfectly encapsulates one of the hardest lessons in all of investing. It leaves us with a really critical question to chew on before those Q4 results drop. Is it possible that a truly phenomenal company isn't automatically a great stock at any price? Keep a close eye on those margins, watch that share count, and we will see exactly how the market answers that question. Thanks for tuning in.